Greetings, Jonathan. Camarda, mid-May update. Let's get rolling. Okay, so where are we? Well, last week's inflationary data came in a little lighter when you watch the press, but it's kind of a mixed picture. So let's kind of delineate amongst some of these indicators they look at. So the CPI, the Consumer Price Index, which actually includes food and energy, came off a bit, not as much. They kind of rounded down a little bit. Although the spread between the CPI and then the PPI, Producers Price Index, is decreasing, which is generally either bullish or bearish for the market. It's kind of a shade of gray, so we'll get into that as well. The thing I wanted to mention with the CPI is when you look at the core CPI, which excludes the volatile food and energy costs, right, excludes it, inflationary pressures were higher month on month. So again, that was kind of covered over by the press there. And so inflation remains sticky. When you look at, again, what the Fed looks at, which is the CPE as well, another consumer index there on expenditures, essentially again, remains over that 5% level. So inflationary pressures are pretty sticky. Now, when you look at the CPI, PPI spreads, they have reduced. They've come down. That's generally bullish in a sense, where, again, prices are coming down, but it also means squeezed net profit margins for companies. So what does all this mean? I mean, it is a cluster, right? So let's take another step back, again, with everything that's out there. And now, when we start to look at exactly the recessionary pressures, we have business confidence going down, and we also have an inverted yield curve, which is recessionary. Of course, the recessionary winds keep being pushed off by this persistent inflation, like we talked about stagflation, on our last few casts there. And stagflation, again, is where you have persistently high costs for consumers and zero growth. And where are the growth catalysts? Well, speaking of catalysts and growth, we go over earnings. 78% of the companies did well versus their projections. Problem was, is that level of expectations was lowered due to the recessionary fears and as such. So therefore, not that great when you take off the Pollyanna glasses. Market-wise, the market as a whole, again, another dichotomy this year. If you look at the S&P, it's up a few percentage points there. But if you look at the equal weight, like we talked about last time, just small, mid-cap, and large cap combined in equal weighting, it's flat for the year. And here's the real troubling thing. As we've had technologies go up, right, and as such, and large cap tech, which we've been participating in, go up, it has been very concentrated in the winners because when you look across the board, and especially the small caps, which you generally need to have the charge of small caps doing well to actually begin a new bull market, they have been lagging significantly, although a little bit better from flatline last week. So what does all this mean? Well, a lot of clouds also overhanging with the mixed inflationary data that we just went over. Now you have the debt ceiling, which we talked about the nuances there are paying it off, as far as what that means between an actual and technical default. But all that aside, I do not want to dismiss the fact that volatility for the markets could be great or could be very little. If they get their act together, we shall see, as apparently they're talking and such from that standpoint. But what does it mean for portfolios? Well, strategies have been pretty opportunistic, to the upside, being more, again, aggressive here during the uptrend. However, as we move closer and closer to this deadline, you'll see in some of your tactical strategies like Global Macro, Velocity Raptor, your Sector Momentum, which already took a breather into the 4.5% cash fund, and Macro Momentum, you may see some shifts there. Opportunistic growth in income, which is more of your dividend stock portfolio, tends to stay in longer. We shall see again if they roll back and take some of those gains off the table as well if this thing becomes more ominous. It really is a moving picture. So again, you'll just have to bear with me on the clarity because, again, some of these changes may be made as we're starting to see and the computers are starting to take in the data as far as the probabilities and the outcomes. That's, again, the beauty of the platform is you don't have to worry about it. It's all spoon-fed and taken care of for you. However, if you have questions or concerns or thoughts as you're looking in your own accounts, certainly talk to your private wealth advisors there to, again, go through and make sure that your risk appetite fits with what your allocation is because that's what counts. It's your money, and we never forget that. So as, again, we look beyond that, a lot of clouds in the air. The market is also bumping ahead against resistance in the S&P 500, for example, which is the market. We're looking at about 4,200 as, again, it's locked in that zone. Now, here's the other thing. The market is not Again, going back the last, almost last couple of months, has tracked within a 3% range. Again, generally that's what they call in technical analysis a pretty tight bow, which could break either way. We shall see. We have some of the catalysts like we talked about on the bearish side, along with the seasonality of May. But then again, the market again can climb that wall of worry. So again, you can't be too black and white and exactly on the moves you're making. So again, I guess today's mantra is a shade of gray and then some. A lot of indicators. Again, there's no test on this. So as far as delineating between them and as such, don't worry about that. Just know that, again, we are looking at the lanes in which we're driving through, looking at the weather, proverbially speaking, and we'll make the adjustments that we see as prudent, but there are a lot of moving pieces. This is a 3D zero-grav chessboard for sure. Again, with inflationary, non-inflationary, a little Shakespeare there. It's a mixed bag. Recessionary, the winds are there. Growth prospects down, inverted yield curve, and yet sticky CPI, PPI, and CPE numbers. Again, bifurcated. Market trending up. Yes, earnings was okay, lower expectations, but very concentrated in the winners this year, like your semiconductors and the such there. We also like gold in this situation, which has been doing well, in these markets, as well as the silvers and the such. But again, they don't pay any interest, so it'll be very interesting to see against the backdrop, how those hold up, especially in this time of volatility. We do like some of those positions. And then your active capital preservation, which we forgot before, say the best for last, has definitely stocked up on some of those precious metals, as well as to a smaller extent the global macro tactical strategy as well. Again, you probably had enough of me for the week. However, just understand that we again are spinning those plates, staying on top, eternally vigilant. Until next time, stay frosty. Easier said than done. Jonathan Camarda. Ciao.